Iron Condor, a tackle trading glossary video. By definition, the Iron Condor is a limited risk, limited reward, neutral cash flow options strategy designed to have high probability of profit when the underlying security is range bound within a certain price level. This strategy results in a net credit and is considered a theta strategy as it benefits from time decay. The construction of an iron condor requires the trader to buy and sell 4 options contracts, 2 puts and 2 calls, with 4 different strike prices, all with the same expiration date and same underlying security. The iron condor is made of a bull put spread, the bullish option strategy, and a bear call spread, which is a bearish option strategy, traded at the same time. Formula: iron condor equals bull put spread plus bear call spread. Here's an example. You'll notice the profit area on the iron condor is going to be in the middle of the range. If the stock price moves too far up or too far down past your strike prices, you'll move past your break-even points and experience a loss on the position. You will build profit over time if it stays in the middle, time passes, and volatility stays the same. At expiration, if the stock price is in the middle of your strike prices, you will have received and made a full profit. Thank you for joining us. Learn, trade, connect, succeed. Visit bit.ly/jointacklepro and get a 15-day trial of the premier online community for traders, tackletrading.com.